Welcome back to EDS, and in this video I'm going to show you how you can generate consistent returns and write your own options contracts even if you have a small account. So the first thing you want to do is open up any equities underlying in your brokerage platform. We've got BA open at the moment, which is just Boeing, and you want to navigate over to where you can see a list of expiration dates for that specific underlying. Now, it doesn't matter which underlying you pick because all expiration dates for all equities are the same. So BA is just a proxy, it could be anything. And the purpose of this is we want to lock in on an expiration date, not the underlying, but an expiration date that we can use across any equity that we uh, think is suitable to put a trade on. So the expiration date that we choose needs to be between 30 and 60 days out in time. It also needs to be a monthly, not a weekly or quarterly expiration date. Now, the only expiration date that actually fits that criteria right now is February 21st, 2025, which is 59 days away. The one before that is January 17th. This is called the front month, and then February would be the back month. So the back month is the one that we're going to go with, which is 59 days away. The expiration date is 59 days away. So we can take that information, come over to our watch list, and simply filter out any and all underlyings that have an earnings event over the next 59 days. The reason for this is because leading up to an earnings announcement, we'll get an increase in volatility, and then post earnings announcement, we can get a big change in our deltas on our contracts, and both of these things will have a negative effect on our P&L. So we want to avoid these things, and we also want to filter out any underlying that has a low liquidity rating level. The reason for this is because we only want to trade liquid markets. The more liquid the market is, the tighter the spread. The spread is simply the difference between the bid and ask, and it's what you pay every time you get in and out of a position. So the more liquid the market is, the tighter the spread. The tighter the spread, the less you pay, which means you keep more of your profit. So that's why we do that. And at this point, I personally like to order everything from high to low IVR. This is personal preference. Some people like to order it from percentage change. It doesn't really matter too much. This is just a pre-made watch list. You can use any watch list that you like. It really doesn't matter what you choose, um, just as long as it has a nice selection of underlyings, because you want to be adding to your portfolio in a way that complements it. You don't want to be too heavy in any one sector. You want to stay nice and diverse. You can use beta weighting, you can use correlations to the SPY, but as long as you use common sense, you'll be absolutely fine for the most part. Unless if you have a really, really large portfolio, by all means, you can use this stuff. I personally just use common sense. This is a very small example portfolio, so don't pay too much attention to what's already in this portfolio. We're just doing it for example purposes. Um, okay, so what we want to do at this point is simply go down the list, see what would fit well in your portfolio. For this example, we're just going to assume that you have nothing in your portfolio, so you can choose absolutely anything that you like. And you also want to keep in mind the size of the underlying, because you don't want to trade something that's too small. If something is too small, what will happen is it will become difficult to find the right strikes that you want to sell your contracts on. So generally speaking, what I've found is anything between $40 and $50 and above is generally okay. Sometimes $30 can be okay. As you can see here, GDX trading at just over $34. GDX can be okay. We have had positions on GDX before. And we also want to keep in mind the implied volatility rank. Generally speaking, anything over 50 can be considered high. However, over 30 can also be considered high as well. It just depends on the situation. And then, of course, you have the absolute implied volatility level over on the right. Now, or any half decent broker will display this same information. It might look slightly different, but it's all basically the same stuff. So, GDXJ, just to prove a point, we're going to go with GDXJ trading at just over $34, a nice and high IV rank of 59.5. and we've got an absolute IV level of 34.7. We've already got a position open on GLD, which is actually working out quite well for us right now. So let's just have a look at GDX. Let's go over to the expirations list. And of course, we already know February 21st, 59 days out in time. This was the purpose of doing that initial step at the beginning of the video. So we open up that expiration date, and now we are presented with the options chain. The market is currently closed right now, so take these prices with a pinch of salt. The spread here, I'm sure, will tighten up once the market opens in about half an hour. Um, but uh, but yeah, we're just going to carry on a mock up a position nevertheless. So this horizontal orange line shows us where the price of GDX currently is with respect to the strikes, and this vertical orange bar shows us what the expected move of GDX is over the next 59 days. Now, as option sellers, we don't want price to breach our strikes. If you're buying an option contract, you want price to move in that direction, and you want price to blow past that strike if you're selling it out, if you're buying it out of the money. And you want to basically be in the money as much as possible. So we're taking the opposite side of that trade, and we want to be out of the money as much as possible. So we don't want price to go anywhere near our strikes. So what strikes are we going to choose? Well, we want a high probability of success, and we already know what the expected move is, as we can see here. So what we're going to do is we're going to sell contracts outside of this expected move to give us a high probability of success. Now, the question is, how far outside of the expected move do we go? Well, we've also got these dotted blue lines here. As we can see, these are our standard deviation levels. So generally speaking, you want to be around a 1 standard deviation mark. And for anybody that knows how or doesn't know how standard deviations work, basically anything within a 1 standard deviation range has a 68% chance of coming to fruition. So basically, there's a 68% chance of price staying within this 1 standard deviation range. That's probably a better way to put it. So we want to be outside of this expected move, somewhere in and around of the 1 standard deviation mark. And generally speaking, I like to go anywhere from a 15 to 20 delta. So on the delta column here on the call side, as we can see, there's a 15 and 20 delta, both sitting perfectly on the edge of the 1 standard deviation level. I'm going to be a little bit more aggressive here and just go with a 20 delta. In fact, we can be more aggressive later. Let's just be conservative and go with a 15 delta at the 40 strike. And we can do the exact same thing on the put side. There is a 19 delta and a 13 delta. Let's just go with the 13 delta over here at the 30 strike. Now, what you'll notice is that we've basically created a range for ourselves between $30 and $40 on GDX. Now, what this means is that we do not want the price of GDX to go outside of this range. We want GDX to stay inside this range. And as long as GDX stays inside this range at expiration, which is in 59 days' time, we will keep 100% of the premium that we collect up front. Now, what is the chance of price staying inside this range? Well, there's a pop, which is probability of profit of 77%. So what that means is there is a 77% chance of making at least 1 penny on this position at the point of expiration. Now, if we want to get out of this position at 50% of max profit, and we don't want to wait all the way till the end, there's an 89% chance of being able to get out of this position with 50% of the max profit at some point over the next 59 days. So we're looking at probabilities of success of anywhere between 77 and 89%, depending on how long we want to hold this position. These are clearly some very, very high probabilities of success, and that's exactly what we want when it comes to writing and selling options contracts. Let's say, for example, if we were to take profit at 50%, we've got an 89% chance of being able to do that successfully. What that means is for every 10 trades, 9 of them will be successful and only 1 of them will be a loser. Now, when we write options contracts, and when there are things that we can do once a position has been filled, once an order has been filled and we've got the position live. If a position moves against us, we can manage risk, we can make adjustments, we can do things to work a position back to break even or even a slight profit. So it's much easier to have 9 winning trades, 1 losing trade, and then manage that one, as opposed to having 1 big winning trade and then managing 9 losers. So this is why we do it this way. Now, the premium that we collect up front is shown here, which is 63 cents. There's a contract multiplier of 100 for equities. Each contract controls 100 shares of the underlying, which means you'd multiply this number out by 100, which gives us a max profit of $63. So we would collect $63 up front, and we have a max loss of unlimited, as we can see here. Now, you wouldn't actually take an unlimited loss. However, technically on paper, there is an unlimited loss potential. As long as you're managing risk correctly, as long as you know what you're doing, you'll be absolutely fine. Our broker is going to require $344 in order for us to open this position. Now, if this max loss number here, this unlimited max loss potential makes you feel uncomfortable, that's completely fine. Or if you have a smaller portfolio and you don't necessarily want to put yourself at risk like this, that's completely fine. Or if the buying power requirement is too high for you, that's also completely fine. I'm going to show you how we can solve all of these problems in one swift move. So what we can do is, the red contracts here shows us, or the red markings are showing us the contracts that we're short. So what we're simply going to do is we're going to go long on some contracts a little bit further out of the money. So let's say we go $2 wide, as we can see here. So $2 wide, 40 and 42. Our max risk is, before we do that, let's do the same thing on the put side to keep it equal. So we've got $2 on either side. So we've basically got a spread of $2. Now, what that means is our max risk is now defined. No, it's not unlimited anymore. It's now whatever the spread is between our short and long contract, which is $2 minus the premium that we collect up front, which is 33 cents. Multiply that out by 100 because that's the contract multiplier, and we now arrive at a max loss of $167. And our buying power requirement has been reduced because our broker knows what our max loss is, and it now only needs to hold that much in buying power to cover us in the worst case scenario. So, what we can do in this situation is be slightly more aggressive, because as you notice, we have a slightly lower, the probabilities of success slightly reduce when we cover our shorts like this and our position is no longer naked. And what we can do is we can simply be a little bit more aggressive. Still keep it $2 wide, but we can be a little bit more aggressive and we can collect a little bit more premium up front, and our buying power requirement will reduce even further. We can be even more aggressive and go with the 26 delta on both sides, and this would be a position that I would be more inclined to actually put on if we were going with the covered position as opposed to a naked position. So our probabilities of success are reduced slightly. We've still got a 67% chance of hitting 50% of max profit. However, if you look at our return on capital now, we're looking at making $75. That's our max profit. And we're now only required to put up $125 in buying power. So if you look at this from a return on capital standpoint, this is now much higher, much more aggressive. The trade-off is slightly lower probabilities of success, but we've still got very high probabilities of success. And this would be a trade that I'd be more inclined to put on if we were going along the covered position route. And of course, we can be slightly more conservative if we were to go with the naked route like this. Now, having said all of that, how do you know how much buying power you should be allocating to your positions? Well, in order to figure that out, we've created a free position sizing template that's free for everybody to use. The link is in the description. And the way it works is you enter in the size of your portfolio at the top. Let's say you've got $15,000, And then below that, you will then enter in what the current VIX level is. Let's say if it's 32.4. Everything below will then be automatically calculated for you. And at this point, all you need to do is use this information to form the backbone of your portfolio. It will tell you the maximum amount of buying power that you should be allocating to any single defined risk position, undefined risk position, how much of your portfolio you should be allocating to short premium strategies. And as long as you follow this over the long term, you'll be absolutely fine. You won't have any issues. And if you want to learn in more detail about what we do and how we do it, again, link in description. This time, click on EDS Premium. Get yourself signed up. Inside, you'll have access to our portfolios that will allow you to see the trades that we're placing, how we're managing risk, the adjustments that we're making, all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. If you do ever get stuck, it is a private community, so you can speak with myself directly or with other like-minded individuals. There's also a 100% money-back guarantee. So once you have studied our full course and followed our trades for at least 6 months, if at that point you haven't been profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free from your part. And right now, it's £1 a month to join. The price is so cheap because we've just launched. However, the price will be increasing, but once you're in, the price is locked in for you for life. And the aim of EDS Premium is to get you to a point where you can write options contracts and generate consistent returns for yourself and for your family for the rest of your life. You learn the skill, no one can take it away from you, and we aim to get you to that point within 6 to 12 months. Of course, you're always welcome to stay and be a part of the community. However, within 6 to 12 months, you should be able to do this consistently by yourself for the rest of your life. So, with that being said, I will see you guys on the inside.